As we age, our tax situation often becomes more complex. Retirement income, Social Security benefits, required minimum distributions. It's enough to make anyone's head spin. But knowledge is power. And that's exactly what we're here to provide today. In this article, we'll explore 5 common tax mistakes that seniors make and offer practical advice on how to avoid them. The first mistake many seniors make is misunderstanding how Social Security benefits are taxed. Contrary to popular belief, Social Security benefits can indeed be taxable. Up to 85% of your benefits could be subject to federal income tax, depending on your total income. This is calculated based on your combined income, which includes your adjusted gross income, any non-taxable interest, and half of your Social Security benefits. For single filers with a combined income between $25,000 and $34,000, or $32,000 to $44,000 for joint filers, up to 50% of benefits may be taxable. If your combined income exceeds $34,000 for single filers, or $44,000 for joint filers, up to 85% of your benefits may be taxable. To avoid being caught off guard, it's crucial to plan ahead. When budgeting for retirement, factor in potential taxes on your Social Security benefits. Consider spreading out retirement account withdrawals to keep your yearly income lower, and consult with a tax professional to strategize ways to minimize your taxable income. The second common mistake is overlooking valuable tax deductions and credits. As we age, we often become eligible for new tax breaks, but many seniors aren't aware of them. For instance, if you're 65 or older, you're entitled to a higher standard deduction. For the 2024 tax year, that's an extra $1,850 for single filers and $1,500 per person for married couples filing jointly. There's also the credit for the elderly or disabled, available to those 65 and older or those retired on permanent and total disability. This credit can be worth up to $7,500, depending on your income and filing status. Don't forget about the medical expense deduction. If you itemize your deductions, you can deduct medical expenses that exceed 7.5% of your adjusted gross income. This includes costs like long-term care insurance premiums, hearing aids, and even home modifications for medical reasons. Charitable donations, including goods and mileage for volunteer work, are also deductible. Lastly, you can deduct up to $10,000 in state and local taxes, including property taxes. To maximize your deductions and credits, keep good records throughout the year and set up a simple filing system for receipts and important documents. Don't be afraid to seek help from a qualified tax professional, as tax laws change frequently, and they can often find deductions and credits you might have missed on your own. The third mistake involves mishandling required minimum distributions, RMDs. These are mandatory withdrawals from certain retirement accounts that kick in when you reach a specific age. As of 2024, you must start taking RMDs when you reach age 73. This age will increase to 75 in 2033. The amount you must withdraw each year is calculated based on your account balance and life expectancy. Failing to take your RMD can result in a hefty penalty, 25% of the amount you should have withdrawn. To handle your RMDs effectively, mark your calendar to ensure you don't miss the December 31st deadline each year. Consider qualified charitable distributions, QCDs. If you're charitably inclined, you can donate up to $100,000 of your RMD directly to a qualified charity, satisfying your RMD requirement without it being included in your taxable income. Remember to plan for taxes, as RMDs are generally taxable as ordinary income. You might want to start taking your RMD earlier in the year to spread out the tax impact. Some financial institutions allow you to set up automatic RMD withdrawals, which can help ensure you never miss a distribution. The fourth common mistake is ignoring the impact of retirement account withdrawals beyond just RMDs. This includes any money you take out of your traditional IRAs, 401ks, or other tax-deferred accounts. Withdrawals from traditional IRAs and 401ks are generally taxed as ordinary income, meaning they're taxed at your highest marginal tax rate. Roth IRA withdrawals, on the other hand, are typically tax-free in retirement, as long as you're over 59 and a half and have held the account for 5 years. When you sell investments in taxable accounts, you'll owe capital gains tax on any profits. The mistake many seniors make is not strategizing their withdrawals to minimize the mental tax burden. To avoid this, understand your tax brackets and how additional income might push you into a higher bracket. Consider a mix of withdrawals from different types of accounts to potentially keep your taxable income lower. Use lower income years strategically. If you have a year with less income, consider converting some of your traditional IRA to a Roth IRA. You'll pay taxes on the conversion, but future withdrawals will be tax-free. Be aware of income thresholds, as additional income can affect things like your Medicare premiums and the taxation of your Social Security. Lastly, Consider tax loss harvesting. If you have investments that have decreased in value, selling them can offset gains in other areas and potentially lower your tax bill. The final common mistake is failing to plan for estate taxes. While federal estate tax only applies to estates valued over $12.92 million for an individual or $25.84 million for a married couple, as of 2024, some states have their own estate taxes, often with much lower exemption amounts. A few states even impose inheritance taxes on heirs who receive an inheritance, regardless of the total value of the estate. And even if you don't expect to owe federal estate taxes, it's crucial to plan ahead. You might be under the federal limit but still owe state estate taxes. Tax laws can change. The current federal exemption is set to be cut roughly in half in 2026, unless Congress acts. Even if you don't owe estate taxes, your heirs might face significant probate costs and delays without proper planning. Consider strategies like gifting. You can give up to $17,000 per person per year as of 2024, without it counting against your lifetime gift tax exemption, using trusts to manage your estate and potentially reduce taxes, making charitable donations to reduce the size of your taxable estate, and using life insurance to provide liquidity to pay estate taxes without having to sell assets. Remember to review your estate plan regularly, especially after major life events or changes in tax law.